Thank you all for coming. I'm David Coughlin. I'm the Associate Director of the Program in Economic Policy Management and the Center on Global Economic Governance, and we're very happy to have you all here today. I'm going to be short because I'm going to pass off this mic to our esteemed guest, Miguel Urquiola, the Vice Dean of SIPA, who will be giving the opening welcome remarks and introducing our gracious panelists. Miguel.
Great. Thanks very much, David. I'm Miguel Urquiola, as David mentioned, and I'm here basically because our Dean, Merit Jana, is out of town. And this is why I'm giving the welcome. Otherwise, I would still be here, but I would just be seated over there. So I am very, very happy to introduce the three panelists this afternoon. As you all know, SIPA is basically deeply committed to serious academic work and serious engagement with policy in a globalized world. And these sound like buzzwords, but there are people who actually make this all true, and it's very hard to think of a better trio that could embody this than the one we have this afternoon. It is easy always to introduce people who are extremely well known and extremely good, so I will be very brief in introducing them. Let me start with the two panelists, Andrés Velasco and Svejnar, and then I will also introduce the chair, Guillermo Calvo. Andrés Velasco holds a PhD in economics, which he earned here in this building. And he has held tenure track or tenured positions at Columbia, NYU, and Harvard. And he has dozens and dozens of academic articles. He was also the president of the Latin American Economic Association. So this, in many books, you would think, well, that's an academic career, and that's great. But as if that were not enough, he served as finance minister for the entire period of the Bachelor administration in Chile, undertaking this job when there what often is a hard time actually to be finance minister when there's plenty. And by all accounts, he did an excellent job doing that, so much so that he has recently finished a campaign for president in Chile that luckily for us was ultimately unsuccessful, and therefore he joins us as basically professor of practice. So we're really, really delighted to have him here, generally at SIPA, and here this afternoon. Jan Svejnar holds a PhD in economics from not so far from here, from Princeton University, and he has held tenure track and tenured positions at Cornell, Pittsburgh, and Michigan, both in policy schools and business schools. He's one of the leading experts on the economics of basically transition, and like Andrés, he also has had a deep involvement in policy in different regions of the world. One notable aspect in his career is he was one of the key founders of CGEG, the Center for Economic Research and Graduate Education in Prague. And like Andrés, he also ran for president in the Czech Republic. And so we're also happy to. Normal for you. This is not normal, but these are two examples here, and we are delighted to have him here at Columbia as obviously a faculty member and as the director of the Center for Global Economic Governance. So they will be our panelists, and our chair this afternoon, giving everyone instructions and leading us will be Guillermo Calvo, who is really one of the preeminent monetary economists of our time. He is what I would call a macroeconomist, so much so that he, in fact, was Andrés' teacher. And he has made major and huge contributions to this field. He received his PhD from Yale and has held tenure track or tenure appointments at Columbia, Penn, and Maryland. He did not run for president, but
not yet.
He's from Argentina. I'm from Bolivia. These are probably places where it's a good thing not to have run for president. Nonetheless, Guillermo has been deeply involved in policy issues as well, serving as a senior advisor at the IMF and as a longtime chief economist at the Inter-American Bank. Here at Columbia, he's a professor, obviously, and also our director of PEP and many of the students who are here. So, as you see, I could not leave you in better hands or with a more distinguished panel. So with that, I welcome all of you, and especially welcome our guests, and I will leave it to Guillermo to say what goes on next.
Okay, thank you. Okay, well, thank you very much, Miguel. You have set very high standards for this panel, and I hope that we can stand up to the standards. The topic is, everybody knows, we call it Fed tapering and the fortunes of nations, and maybe one can alternatively call it Fed tapering and the wheel of fortune. because that gives a sense of the uncertainties that we are facing. And we thought that given the importance of this episode, even though we are at the beginning of a phenomenon that we're still beginning to grapple with, that it would be worth to get together, all of us, and led by these two eminent economists in this field, to try to cast some light on what's going on. So as a chair, I'm not going to be making a presentation, but I thought I should put some of the issues on the table, and then I will turn the floor to my colleagues. I guess the first point that I'd like to make is that the effects of Fed tapering is another episode of a large shock, a surprising shock, and a widespread shock. I think very few people expected this to happen. There was a lot of talk that there might be bubbles out there, but the nature of these bubbles, or if it is a bubble, is quite surprising, because once again you see the impact in all corners of the world. Economies like the Indian economy that was supposed to be one of the champions is in trouble, together with Indonesia, Brazil, and Chile. So why is this happening? This is not something that we are prepared to address or for understanding on the basis of conventional economics, because conventional economics tends to tell you that phenomena like this are a result of some fundamentals which are not necessarily financial fundamentals gone wrong. So this is happening not only in one individual country, but in several at the same time for several parts of the world. So once again, we are faced with a phenomenon that we saw at least since 1994. The tequila crisis had these characteristics, exactly. At least on the surface, something that nobody expected. Here you had India, but in that case you had Mexico, that was the poster boy of the IMF, and all of a sudden, almost overnight, the perception of the economy changed. And it became practically a basket case and affected many other countries. So that's why this is very, it's something that we have seen and we are still trying to understand the phenomenon. So several questions related to this that one would like to start at least giving some answer. One question is, what caused this? Was it the Fed tapering, the removal of this expansionary policy that sometimes is called QE, quantitative easing? Was it that, or was it that the market perceived that the U.S. economy was well into a recovery phase, and that the talk about tapering at the Fed was a signal that the Fed also thought that we were moving into the next stage where recovery would be faster, where interest rates would have to go up, because present interest rates, particularly the 10-year bond interest rate is still very low compared to historical standards. So it could be a matter of signal, or it could be just a tapering, Fed tapering. What was, and what determined, what was the key factor here? And being able to explain that is important, because that will give us a sense of whether this is a phenomenon that is here to stay if the U.S. continues recovering, or it's just a little accident on the way. The second big issue is the extent of the impact. When you look around, you find, say, for example, Brazil, the exchange rate devalued by about 20%. That's a very big devaluation. And so big, and it would have been bigger if the government did not intervene in a big way. So what is behind that? Is it financial vulnerabilities? Countries have gone through this crisis before, so they have taken measures to protect themselves. And one of the measures have been a huge accumulation of international reserves. So they had reserves to defend themselves. And actually, Brazil is doing that, putting $60 billion on the table to stabilize the exchange rate. And yet, the effects are there, both of the exchange rate and also the rate of growth. Sorry. So one issue is to identify the vulnerabilities, and related to that, what can the IMF do about it? Another issue is policies to deal with this type of shock. What can individual countries do? Should they stabilize the exchange rate? Should they extend credit to markets where there is a credit squeeze, which is typical phenomenon here? Extension of credit to particular sectors is akin to quantitative easing in the US. While here, quantitative easing has taken the form once of buying toxic assets. In countries like Brazil in 2002 and 2008, quantitative easing took the form of extending credit to some strategic sectors like the export sector. So what should economists do when faced with these kind of shocks? I don't think we have a very clear-cut answer about it. Actually, you see some countries like India yesterday announcing that it will raise interest rates, but this is an episode of capital outflow. But also here, that when there is an episode of capital inflow, countries also increase interest rates. So they increase interest rates for both episodes. We still need to understand more deeply what is the right thing to do. So these are all open issues. And finally, another big issue is coordination. These shocks affect the whole economy. The independence of the central bank, which is a very valuable institution, is not necessarily the optimal thing during a crisis, because the central banks, many cases, like in the US, the central bank not only has control on monetary variables, but some of the actions and policies that it takes are fiscal in nature. When you buy, for example, toxic assets, it could very well be the case that the central bank is losing money, in which case what it's doing is basically a subsidy to certain sectors. So that needs coordination. It cannot be only in the hands of central banks. How to do it? And here we have the fortune of having Andrés, who went precisely through an episode of that type in Chile during the Lehman episode in 2008. The fiscal authority was very aggressive. It kind of coordinated with the central bank, but the central bank did not appeal or resort to quantitative easing. In any case, the result that probably the recession was less pronounced than it would have been without the fiscal kick, but still output fell. So it'll be interesting to hear Andrés' reflections about that episode. And finally, the future. How to protect. How should countries protect themselves better? it looks like the accumulation of reserves is not enough, or maybe we don't know how to use them properly. What was missing? Is there something better that we can do? And here is a list of issues. The first three ones, which I have in my notes, are in the hands of local authorities in emerging markets, which is international reserves. Are they enough? Credit lines, macroprudential regulations, controls on capital mobility. Those are all issues that have come up. But also there are global issues. This phenomena that we see at the global level, several countries being hit at the same time, it's not very different from what we have seen at the national level in the past, in the 19th century. And we invented central banks to take care of that. But it so happens that we don't have a global central bank, and it's very hard to set up one. The fund is very, very limited. It's trying to move in that direction, but it's very far from being a world central bank. De facto, my feeling is, and I don't know if my colleagues will feel the same way, is that the Fed has become the world central bank. Now, when you are the world central bank, you start doing things. When you do things, you affect not only the US, but also you have an impact on the rest of the economy. So you see the reaction of emerging markets once the tapering issue came up. Many said, stop, don't do it now. I mean, give us time. But of course, Bernanke's mandate has nothing to do with the rest of the world. That's the way we have organized the institution. So here we are in a situation where I believe the Fed is playing a central role, and yet is not perhaps duly internalized in the workings of the institution. In any case, these are many, many issues, but now I'm ready to stop and let my colleagues enlighten us. Please, Andrés.
Thank you very much. Delighted to be here. Thank you, Miguel and Guillermo, for those very kind words of introduction. I have to say that I'm absolutely terrified to be here because I am in the presence not just of my dissertation advisor, who happens to be sitting here on my right, from whom I took many classes, but also in the front row here's Al Stepan, who's also my teacher once I was an undergraduate. So I have two of my mentors to answer to, and I'm sure they will be scrutinizing every word I utter. So terror is what I feel right now. And of course, Jan and I are starting a club. People who ran for president and didn't quite get it. I should add, we lost, but with great dignity.
I think we should teach a course how to lose a presidential election.
As you leave the room, of course, you can make a donation to fund our next run, if you so desire. So we have lots of big issues here, some old, some new, some very much unsettled. And let me see if I can cast a little bit of light on some of them. And I'm going to try to be organized and follow some of the same questions that Guillermo posed, and then add 2 or 3 issues of my own toward the end. First of all, let us just get the facts on the table. The facts on the table are as follows. The Federal Reserve Bank of the United States, for the last year or so, has been buying $85 billion of long-dated assets every month. And the big shock to the economy, and I emphasize big because it is not clear that it was so big, was the announcement back in May that maybe instead of buying 85, they would buy less. How much less, we have no idea, but the market conjecture was that we would go from 85 to something like 70. So this is not a tightening. This is not going from quantitative easing. I'm not quite sure what the opposite is, uneasing. It was, quantitative easing would go on, but at a somewhat smaller pace. What happened to the market in the US? The long interest rate rose by about 1 percentage point, a little bit less than what finance people like to call 100 basis points. If I had asked you in this room, all, seasoned, eminent, sophisticated observers of the international scene, you raise long interest rates in the US by 1%. Does the world come to an end? Most people would have said, 1%, what's 1%? Who cares? Well, the fact is that small rise of interest rates in the US of less than 1% caused, as Guillermo was saying, major tremors pretty much throughout the so-called emerging world. It hit, countries with strong macro frameworks, with not so strong macro frameworks in South America, Chile, Brazil, Peru, Colombia. Then Mexico further up felt a shock. South Africa did, Turkey did, a number of countries in Central and Eastern Europe did, countries in Asia, etc., etc., etc. So the first question is, what kind of a world do we live in which a small shock has big effects? Most theories don't equip us well to think about that, which in my mind kind of raises two issues. The first one is, was that really the shock, or is something else going on? And one alternative way to think about the world, and I think Guillermo and I would more or less agree on this way of seeing the world, is that out there are a number of financially developed economies, but not fully developed, that's why we call them emerging markets, in which there are a bunch of potential vulnerabilities, and I will say a bit more about this in a minute, which can get triggered by things that we don't know how to identify. So in this case, what may have triggered it was this minor change in US policy, but conceivably, if you believe my line of thought, it could have been anything else. It could have been, Larry Summers' appointed to the Fed, or maybe it could have been Larry Summers' non-appointment to the Fed. You may remember that back in 2001, I think it was, Turkey had a crisis, right? And my friend Danny Roderick, who's from Turkey and who sat next, in the same hallway as me as Harvard, would tell that story as an episode in which the prime minister threw the Constitution at the president, and the president threw it back quite literally at the prime minister. No fundamentals had changed, but this, of course, smelled of a political crisis, and suddenly, Turkey was in deep trouble. In the jargon of economic theory, what am I saying? I'm saying that maybe the potential for crisis is out there always, and what you need is what theorists call a coordinating device, something that causes everybody to think, a crisis is coming. And of course, if everybody thinks that a crisis is coming, everybody will act in a way and do things to make sure that the crisis does come. Which is, if you believe that the world we live in, it's a pretty scary world, right? Because the vulnerabilities out there, they're always out there, and maybe they will bite us at unexpected times that arise from unexpected events, some of them small. So that's the kind of shock we're living in, and it's essentially a financial shock. Which then leads us to the question, I think, so what are these vulnerabilities? What is out there that causes these systems to be so unstable? And I should begin by saying that to some extent, and almost by definition, all modern finance is very vulnerable. When we teach macro to undergraduates, we teach them about banking, and the canonical way to think about banking is an institution that takes liquid deposits and invests in long-dated projects. So almost by definition, if people want to get the money out of the bank, you never have enough cash in hand, and if everybody comes to the bank in any one morning, the bank will go belly up. So even well-run modern, banks are vulnerable to that kind of run and that kind of change in expectations, unless, and this is of course a very big if, unless there's someone out there who stands ready to lend to them, what we call a lender of last resort. Today, financial markets in emerging markets are so vulnerable precisely because, A, we have these mismatches, these things that potentially can go from being very liquid to being very illiquid overnight. And in addition, we have no world lender of last resort. Guillermo was saying the fund does not do this job. A big question, which I will leave on the table, I have nothing too interesting to say, is should the fund or could the fund be that? Guillermo's skeptical. Guillermo thinks maybe the fund will never be in the business of doing that, so we need somebody else, be it the Federal Reserve Bank of the US or the European Central Bank or a consortium, who knows. But it is this combination that leaves us perennially vulnerable. And in particular, in emerging markets, the vulnerability is accentuated by the coexistence of two things. Dollarized liabilities. Typically, emerging markets don't borrow in their own currencies. And external deficits. When you correct the external deficit because the world is growing more slowly and because you have less financing, what happens? Your currency devalues. Those liabilities in dollars become more expensive. This wrecks your balance sheet, and a number of problems follow. We have understood that mechanism for a long time. I can think back, I was a student here, people were writing papers about that. The remarkable thing is that even though conceptually the main building blocks are not that mysterious, exactly finding the policies to deal with that has been conceptually difficult and politically very difficult. And the two issues we want to keep in mind. What can you do to minimize these vulnerabilities? Well, there are ex-ante policies, crisis prevention, and then there are ex-post policies, the sort of mopping up after the fact. If you think about ex-ante, there are two things that you can do. The first best, the desirable, the good thing would be to have risk pooling. We're all in this business. We don't want to be in the business of insuring alone against these shocks, so we want to be insured jointly, and that's where international institutions come in. But as I was just saying, international institutions do a very poor job. They're slow, they are cumbersome, and they're small. They're small in that total resources at the disposal of the IMF, the World Bank, the IDB, the African Development Bank pale. I mean, they're just minute in comparison with what you might need. I remember, this is a small anecdote, at the time of the crisis, sitting in on discussions in Washington with the Inter-American Development Bank, they were so proud because they were about to launch a special credit line to Latin American countries for something like $10 billion US. And as I sat there nodding, thinking, this is great, I kept thinking to myself, Chile alone could be spending $20 billion in the next few weeks. It's just peanuts, right? So crisis prevention at the global level is the first best. We've done almost none of it. So crisis prevention at the local level entails what? Accumulating reserves, as Guillermo was saying. And countries have accumulated reserves. What's the problem with this? Well, twofold. First of all, you can never have enough, right? Because your potential liquid liabilities are always going to be larger than your reserves. In technical terms, a broad definition of money, M2, would have to be fully covered by reserves. So the ratio of M2 to reserves would have to be 100% or 1. And if you look around these countries under siege today, that ratio is not 1, that ratio is 0.2, 0.3. So even after this huge accumulation of reserves, almost by definition, reserves are insufficient. And the other problem, of course, that it's expensive. If you have 10% of GDP in reserves, and you're foregoing interest of maybe 1 or 2% a year, that's serious cash. It's a non-trivial share of your GDP that you're allocating to self-insurance. So to summarize, ex-ante crisis prevention, if you do it on your own, is A, very expensive and not very effective. So that takes me to crisis prevention ex post. So not prevention, crisis management ex post. There, I think. I wish I could tell you this is what you want to do, this is the list of policies that work well. The honest answer is that we still have a lot of homework to do. Because one thing that the crisis taught us, or at least reminded us of, because we should have known this all along, is that at a time of panic, financial markets don't work like the textbook suggests that they do. And in fact, the communicating channels among financial markets break down, and therefore the standard tools you have don't work very well. What central banks tell us that they do in tranquil times is they move one thing, that's a short interest rate, and if markets are all connected and nicely arbitraged, you move one thing over there and the whole system moves. But at a time of a crisis, markets become disconnected, they cannot be arbitraged, and therefore you move something over here and nothing else moves elsewhere. And you need direct intervention. But exactly what that intervention looks like, who does it? Does the central bank do it? Does the treasury do it? Do you do it through the banking system? Do you do it directly by lending? What's the political economy of this? You can imagine it's not very easy for a government to wake up in the morning and say, the world is in crisis, I'm going to be giving subsidized credit to the rich, right? The politics of this is not very easy. Some form of such a policy may be desirable, but both the economics and the political economy of it are very, very, very tricky. But I don't want to leave you entirely at a loss for ideas, so let me say one broader thing that may help organize the discussion. We need to move toward a policy framework which is broader and more flexible than the currently fashionable inflation targeting regime which governs monetary policy in most emerging markets. Most of you probably know what that is, but just in case you don't, let me summarize it this way. It is a system that says there's one main target that central banks worry about, that's CPI inflation, and because we have one target, we need one instrument, that's the short interest rate. That's, all that central banks do. The other thing in my mind that the crisis taught us or reminded us of is that you can have very low inflation and have a great deal of financial instability, right? So low inflation may be a necessary condition for financial stability, but it is far from a sufficient condition. So central banks are stuck in a world in which they have to worry about other kinds of inflation and deflation. They have to worry about the price of real estate. We know that in New York City. They have to worry about the stock market. They have to worry about the price of bonds. They have to worry about the price of foreign exchange. And they may wish to stabilize some of these relative prices some of the time. But if you're going to have lots of targets, you need lots of instruments. And what we don't have a clear understanding of is what these instruments ought to be. Is it exchange market intervention? If so, is it sterilized or unsterilized? If it is sterilized, it is using what instruments to do the sterilization? If you're going to intervene in the housing market, or in the stock market, or in the credit channel vis-a-vis exporters or small businesses, who's going to do it? How are you going to do it? Who's going to pay for it, etc.? Let me tell you, regrettably, these are very much open issues. Guillermo alluded to the experience in Chile. Let me tell you what I learned during that period. First of all, I learned that when things get bad, they get really bad. Speaking of Larry Summers, Summers has a line that I like. He likes to say, crises always take much longer to arrive than you think. But when they arrive much faster than you think. And that's exactly right. I was, of all places, in Central Park Zoo when Lehman Brothers went under. I have two small kids. I thought I would, take 2 hours off. I was in New York. I, switched off my BlackBerry. After 2 hours of watching the seals do their thing, I turned it back on. I had something like, 200 messages. So I jumped in a plane, went back to Santiago, and, slept almost nothing for the next 3 weeks. Issues of the coordination of fiscal and monetary policy become paramount at that point. And the honest answer to the question, what do you optimally do in those circumstances, is you don't know. And because you don't know, you try lots of things. And one thing we did try in Chile was a very, very, very aggressive fiscal policy, which was a fiscal policy of the traditional kind. We spent more, we lowered taxes, but we also, it was a fiscal policy which had financial elements in it. For instance, some state enterprises couldn't invest because they were rationed out of the credit market. We gave them equity. We gave Codelco, the big state company, $1 billion in emergency equity so they could carry on investing. We did the same thing with a state bank. In addition, we understood that small businesses were probably liquidity constraints, so we changed the rules for making prepayments on taxes and for giving refunds on taxes. Why do we do that? Because that was destined to alleviate liquidity constraints. So the lines between what is fiscal and what is monetary get very much blurred. Now, in order to do all of this, you need money. And the one thing that I can say about Chile is that I was very happy that we were sitting on a lot of money. We were sitting, the treasury alone was sitting on about 10% of GDP in cash. And of course, accumulating that had taken some sweat. Most of the gray hairs I have on my head come from that episode. And the open question in my mind is whether there are other things that were similarly unorthodox that we could have done. And Guillermo and I have had many discussions as to whether on the monetary front one could also have been bolder. Now, would things have been better or worse had we done things differently? Well, we have no idea what the counterfactual would have been, right? I'll give you the numbers. The shock was gigantic. The real value of Chilean exports fell by 40%, 4-0, between 2008 and 2009. That's a humongous shock. And in spite of that, Chilean GDP only fell by 1% in 2009 and began growing very quickly again in 2010. So was that good? Was that bad? Was it mediocre? It depends what you compare it to, what the counterfactual might have been. Given the history of Latin America, in which much smaller shocks wreak complete havoc with economies, with GDP collapses of 7%, 8%, 10%, 1% doesn't seem too bad. But perhaps one could do better. Let me just end by highlighting one issue that Guillermo did not mention. Beyond the issues of monetary control and the issues of financial stabilization, which are very much sort of at the forefront of concern today in Brazil, in Indonesia, in India, I suspect that you're going to see a serious change in growth behavior over the next few years. Because there are two facts that are kind of obvious but don't get highlighted enough, and I just want to highlight them for you. The first one is that growth in emerging markets over the last 4 years since the crisis was, I want to use my words carefully here, coincided with extraordinarily propitious international circumstances. Carlos Díaz Alejandro, who was my undergraduate advisor at Yale, used to say that emerging markets, or back then they were called developing countries, remember, could be in a state of nirvana when commodity prices were high, world interest rates were low, and world liquidity was abundant. Well, in the last 4 years, we have lived that nirvana. And no matter what the Fed does, nirvana is over. So above and beyond the issue of financial stabilization, you are going to see less growth in almost every emerging market because these extraordinary conditions are very unlikely to recur. And the other fact that I want to highlight is that coming back to planet Earth, when it comes to interest rates or commodity prices, will highlight issues of productivity in emerging nations which have not been addressed. And here I don't want to say something about Asia or Central Europe because I know very little about those regions, but let me say something about Latin America. The behavior of productivity in the major economies of Latin America over the last 2 decades is lousy. You can find an example of okay behavior here and there. Chile did pretty well in the 90s. Peru has been doing pretty well in the last 3 or 4 years. But overall productivity, or I want to be precise here, total factor productivity growth since 1990 has been dismal. And it has been dismal in spite of all the structural reforms, all the stuff that you all know about. This was not visible simply because, under these very propitious conditions, economies could grow without enhancing productivity. If you do a growth decomposition for the main economies of Latin America over the last 5 or 6 years, they've grown mostly because they've added capital and labor, not because they become more productive. If going forward you cannot add more capital or more labor, the only way to grow is to become more productive. And there, most emerging markets in my region of the world have a tremendous deficit, which the bonanza hid, but which now nations will have to address. Let me stop there.
Thank you very much. And thanks, Andrés, for laying out the facts so well. So I'll pick and choose as I go in order to complement what Andrés said and then add a few things from a different geographic standpoint, looking more on the Eastern European and a little bit on India and China. So I think the one thing that I would add that's important to realize is that in the last financial crisis, the one that we're still going through now, that really didn't start in the emerging markets. It started in the US, a sort of developed economy, and the emerging markets got into it on the rebound, so to speak, as decline started, recession started, and some of them there were financial sector problems, but many of them it was the real economies that were affected. And so then, of course, the quantitative easing that we have observed over the last 2 to 3 years then started having effects as people who suddenly had more money in the advanced countries, the easing started, was in Europe as well, not just in the US, but in Europe as well, started, of course, moving money into the emerging markets. And you have kind of 3 phases as people identify it, QE1, 2, and 3 over time. And so to the extent that this easing stabilized the developed countries, then of course it helped the emerging markets as well, by stabilizing the world economy compared to where it would not have been. So that's of course very good. There have been some positive spillovers therefore from the developed to the developing countries and some sort of redistribution effects going with it. But there were potential negative externalities, negative spillovers as well. You had excessive credit, there was worse quality type allocation of resources, asset price distortions, financial fragility, and so on. And so the basic danger then starts being that this ending of the easy money or tapering, even if it's not stopping, but just slowing the rate of growth, can have effects. And as we've been seeing, at least in some of the economies, and as Guillermo mentioned, there could be really tremendous, dramatic, much greater than what we would have expected. So in some sense, there is a question sort of what happens. When you look at the various emerging market economies, you see that they seem to have been flooded by this easy money to very different extents. So some got a lot, some got less. And so, for instance, the European emerging markets, the Central Eastern European ones, had much less. The bank flows were much more, much lower than elsewhere. And so here it's interesting to what extent the proximity to the European Union, the Eurozone, and so on, whether that has some effect or not. Wasn't expected because Mexico, in some sense, was not, as I understand it, very different from some of the other Latin American economies, and it's very proximate to the U.S. So that would be interesting to discuss. And so the effects then, are not homogeneous, not uniform. The question is why they are. And the exit or the tapering, depending on how it's done, can also have either very gradual kind of effects or very shocking effects. And I think what we've been surprised by is how major, shocking in a way, these indications of possible tapering off have been. Now, the emerging economies, of course, adopted a number of tools that have been already mentioned here. You have changing reserve requirements and using reserves or not. You have real estate measures. You have limits to foreign exchange exposure, and different countries have adopted different effects. The interesting thing, just for the sake of complete sort of factual knowledge, is that the first quantitative easing, the QE1, had mostly effects on prices of bonds and stocks in the United States or in the advanced economies, whereas the second one then boosted equity prices worldwide. It went much further. So it's interesting sort of what the different phases can also generate in terms of effects. Once you get to the tapering of, or the perception of it, and the accompanying increase in interest rates in the United States, and jumped by a percentage point, which traditionally might not look like much, but given the nervousness and given the recent experience, it was read as a major increase. Interesting, Europe followed immediately as well. So the two largest economies that account for half of the world's GDP moved very much in tandem in terms of how these expectations transferred. That obviously had direct effects on asset markets worldwide then. Exchange rates, the depreciation that we see in some of the economies was major. There were indirect effects in terms of reduced demand from countries that were hit with these negative effects. Input prices, raw materials, as we already mentioned, were affected, and so on. The important thing is that the effects are not unambiguous and can go differently in some countries relative to others. Okay. The IMF has done some scenarios, modeling and forecasting of how this tapering could happen. And even in the models that they have, the effects could be very, very different. In other words, if it's smooth and continuous, they are predicting that, yes, some countries will be hit negatively, but some positively, and overall, it wouldn't be such a major transition. But if it's done more in a jump-like format, and that could be not that the countries intend to do it, or U.S. Federal Reserve intends to do it, but it's expected or read as being such, then the effect could be major negative effect for some economies, and it would be the economies in Latin America, economies in Russia, China, and so on there. Now, there was also a very different effect in terms of exchange rates reaction. In some countries, such as Indonesia, Uruguay, it's on the order of 20%, 18% change in the exchange rate. And then you have, some other countries in the emerging world that the effect was less than 5%. So again, major differences. And the effect now of the latest decision not to, or to deny that there will be tapering coming up very soon, last week's, and this morning, the media brought the news that Mario Draghi, the head of the European Central Bank, basically said that he too was going to provide additional major credit available to all the European banks. So it's an equivalent measure that essentially at very low cost, almost zero interest rate, gives bank a virtually unlimited access to resources. So that has sort of produced major signs of relief. And this would be good to discuss as well. My sense is that it didn't quite undo what the panic of the perceived ending or tapering off did, but there were significant effects. So the Indonesian stock market jumped up by 5%. Rupiah gained quite a lot after that very significant depreciation. The Mumbai Stock Exchange increased by over 3%, and rupee gained 2.5%. So not, swings that were comparable to the opposite swings a little bit earlier, but definitely a reaction. The Turkish stock market increased by 8%, and so on and so forth. So it's actually interesting. India was under quite a lot of pressure, for instance, compared to China. So you see the currency was under considerable pressure, stock market plunged, okay, and in fact the new governor decided to increase the interest rate by a quarter percentage point yesterday or recently to both fight inflation but also to provide sort of a stance, firm stance in this. China seems to be less vulnerable. It's still much more of a closed economy, or the openness is regulated. It has current account that's still positive, much higher reserves than India. I mean, India has high reserves, but not as high relative to the financing needs. And this is what Andrés mentioned is very important. It all depends what your needs are. You could have seemingly high reserves, but they may not be sufficient. Another interesting issue is how countries react to this. I already mentioned some of the reactions. The one that's an extreme example is Latvia and the Baltic countries in general, which decided to just ride through the crisis in a very orthodox way, kept a fixed exchange rate, in this case towards the euro. GDP plunged by about 20%. For some reason, they could politically withstand it, so that's also a question to what politically can you withstand. And they've managed to resume growth relatively fast nowadays. They're still way below where they were when the crisis started, but an incredible rate of increase after sort of going stoically through it. So I think that what is to me appearing in terms of the questions that Guillermo posed, what's the future, which way should we go in terms of accumulation of reserves, credit line, capital controls, and so on, and having global central bank. I think it depends in part what the country is willing to take. I gave the case of Latvia intentionally because that's sort of a juggernaut at a very extreme end of the spectrum that's willing to and able to ride through with essentially not using any of the flexibility that's accorded. To the other extreme, comparing this crisis to the previous crisis, most countries that did not have flexible exchange rate regimes and now have it, really adopted them in part to be able to respond flexibly, both in the short run and in terms of export generation that comes with the depreciation of the exchange rate. So is the Federal Reserve Bank the bank of the world? I think it is, and in some sense, it and the European Central Bank, if Euro survives, etc., could be a good tandem, because as I mentioned, they account for such a large part of the world economy that if they could coordinate, and they might as well. They do coordinate to some extent, although during the crisis, I must say, at the beginning, they didn't coordinate much, but the markets coordinate for them. As I mentioned, the interest rates follow, very, very quickly in terms of what investors ask as a premium and so on and so forth as a result. So let me stop there.
Okay. Well, we've had very fascinating presentations. I'm still very, very worried, I must say. I'm not sure that I would know how to handle this if I was a policymaker at this time, or what to advise. I think what's coming up, the general phenomenon that you both guys have highlighted, that we are living through a period where volatility is at the center, that we still don't understand it very well. And I think partly the reason why we don't understand it, because in economics we have left aside, we have ignored issues having to do with liquidity. The financial sector, yes, but in addition, liquidity issues. We always thought that liquidity could be boiled down to something very simple, controlling money supply. But now it turns out we learn from this crisis that there are all kinds of liquid assets, and that liquid assets can be created. Now I'm putting my 2 cents on the table. So far, I was just the chairman, but so let me just put the 2 cents. So that, in my view, and I think it's shared by Andrés for what he said at the beginning, is with what's at the heart of this. So there are certain issues that I have conjectures. We still have not enough research to feel comfortable about it, but I think we are pressed by the fact so much that we need to do a lot of theory and work on conjectures. And one conjecture is that we've been handling monetary policy in the world, and the U.S. in particular, U.S. and Europe, trying to use the interest rate all the time. I see the kinds of things that we do under normal conditions. And as my fellow panelist indicated, the interest rate is a limited instrument. I mean, Jan, you mentioned that some countries have resorted to intervention, fixing exchange rates, all kinds of things like that, that it's not just using the interest rate. Even countries that were committed to floating exchange rates for a long time, like Chile, intervene in the markets because the interest rate is not enough. In the US, we kept using the interest rate until the very end, until it hit zero. And then we started with QE. Now QE, what is QE? I call it defragmentation, because the idea of QE is to open up credit markets. It's different from the standard monetary policy. So you try to, but what did we do? We waited until we were totally, when the interest rate go to zero and nothing happens. You are playing with something that doesn't work. So we should have stopped and think. I don't blame Bernanke. I mean, they're doing a fantastic job up there. I mean, it's difficult. And of course, that was a conventional thing. That's what I mean. It was a conventional with use interest rate. So when they turned equal to zero, then they started thinking about other ways, and QE came up, or defragmentation came up. Now, some people say, and I have sympathy with that point of view, is that maybe they should have started using QE before hitting the lower bound. Because when you hit the lower bound, what does it mean? It's that you are making liquidity, the real liquidity that's still the market values, with a zero yield. So you give incentives for the guys who work downtown to start creating other liquid assets. And liquid assets are created sometimes through episodes that look very much like a bubble. And if you ever talk to guys downtown, they know nothing about Brazil. Alstep, you could give them lectures forever. I mean, these guys don't know the principles. Maybe they know where it is geographically located in Brazil, but they invest on Brazil because they go have a drink and they hear that the other guy next door is also invested in Brazil. So, but if one day they hear that the U.S. interest rates are likely to go up, they say, oh, maybe my fellow drinker will pull out of the market, so I better pull out too, and everybody does that, and Brazil becomes a basket case. So I think that's where we are at. And by having zero interest rates, we are creating, unwittingly, of course, a situation where there's plenty of room for the creation of liquidity. So now you're right. I mean, the mood has changed. Why? I mean, what happened for exchange rates to change so much? I mean, that's telling you that there is something very strange that has nothing to do with the fundamentals. It's not that these countries all of a sudden started to tighten up fiscal. No, they just stood there, increased interest rate a quarter of a percentage point. What is that? That means nothing. When you are about to have a devaluation of 20% in your currency, if people believe that your currency from today to tomorrow will devalue 20%, what does it mean increasing interest rate by a quarter of a percentage point? Nothing. So it's just signaling that you are intent on really attacking the problem. So I don't think it is interest rates in India that did it. I think it's the tapering, the de-tapering. So I'm very concerned. I just wanted to emphasize that point, and that's why it sort of gives more weight to the notion that the Fed is a central bank. And another piece of evidence, and with this I finish and open up the discussion from the floor. Japan. Here you have the world terribly sensitive to what happened, may happen in Washington, D.C. At the same time, Japan announced that it will double money supply. Well, I look at the numbers and figure out that the increase in money, if money supply is, say, to use a technical term, M1 in the US plus Europe plus Japan, the doubling of Japan is equivalent of increasing world money supply by 40%. So all of a sudden, liquidity, that kind of liquidity was announced that it would increase by 40%. And just the hint that the US would do something that had nothing to do with that M1 would be the same, had a tremendous negative effect. So that once again shows the centrality of the Fed. Well, with this, I finish my 2 cents, and I'll be happy to take questions from the floor. There's a microphone out there. And we have plenty of time for Q&A, about half an hour, right? Mm-hmm. Yeah, so this should be fun.
Two very related questions. One implication of all these kind of what Guillermo said, there's always some danger lurking out there. Little shocks can lead to big outcomes and big impacts and all the risks that both Messrs. Velasco and Jan Svejnar talked about. One implication seems to be very careful with financial liberalization. Is that a general view of the panel? A, and B, once you've liberalized, can you go back in some sense? Have you let the genie out of the bottle? It's very hard to reverse once you have gone in a certain route. And then what are the kind of options that are open to that economy? Chile is often cited as a very good example of how it used some of the capital controls to ward off or reduce some of the risks and uncertainties with a liberalized capital account. Thank you.
Let's take some questions.
Hi. One question for all of you and one to Professor Velasco. The first one, Professor Velasco, you mentioned the Nirvana era for YEM is behind us, and that, but I wanted to ask you whether there is still a strong case for investing in YEM. At the end of the day, you remain very young nations with very low debt, with quite good growth, interesting credit spreads, especially for Chile. I know Czech Republic, you've got very, very low yields, but you remain a very interesting investment. So my question is the following. After the end of QE, we sure will have a wave of panic, but these currencies will cheapen, these stocks will cheapen, the stocks will cheapen. It could be an interesting opportunity actually to be in YEM because these fundamentals, do you think, are being affected? And if you don't agree, maybe it would imply that the Fed has been building a kind of EM bubble in the last few years, which is about to burst. And the second quick question is, you mentioned we should move away from inflation targeting. So what should we target? Unemployment? Should we target output? As in England, they are just starting to talk. I just wanted you to elaborate a bit more on that. Thank you.
Two questions for Professor Velasco. You had noted that in Chile you had employed measures like rebates for small businesses and so on. Now, I'm familiar with the IMF. They say it's mainly fiscal, but it's totally macro. So I noticed that, do you see a greater role for micro measures, both crisis prevention, like for instance, margin requirements or real estate regulations, and also for crisis resolution? And second, fiscal hasn't been mentioned in this forum. But arguably, as a response to Professor Calvo, if fiscal had acted faster, there may have been no need for QE, and therefore these bubbles might not have been stimulated. And follow up to that, in the next 2 weeks, we may be seeing a fiscal shock, and hence we may not have seen anything yet.
Okay, I think are you ready to answer now?
Sure.
And then we take a second.
Let's see, a bunch of important issues here. Financial liberalization. Am I of the mind that one should be careful with it? Yes, very much so. However, one should not jump from there to the conclusion that because you've got a capital control here and a barrier there, you are immune. If you are a truly self-sufficient, financially self-sufficient economy, or quasi like China, maybe you're in a different ballpark. But most of the emerging markets we're talking about here, through many challenges, are pretty integrated into the world financial markets anyway. And I have no great, moral or religious objection to thinking that capital controls may be a useful tool, but I would think of it as one tool among many. If you go back to the framework I suggested earlier, if we're going to be targeting a bunch of things, we need a bunch of tools. And I would think of capital controls as one such tool, not a panacea. Which takes me to the question of, inflation targeting. I didn't say, maybe I didn't quite put it right, that we should abandon inflation targeting. Far from it. I think that, having grown up in a country where inflation was 700% and nowadays it's 3%, let me tell you, 3% is much better than 700%. So having brought inflation down in a fairly sustained and predictable way is a tremendous achievement, whether in Brazil or in Mexico or in Chile or in Bolivia or in many other places of the world. What I did say is that we should worry about other prices, not simply the price of a basket of goods called the Consumer Price Index. There was a huge debate in macroeconomics, and Ben Bernanke was a big participant in this debate before the crisis, back in, a decade ago, as to whether monetary policy should target other things. Should it worry about the stock market, housing prices, whatever? And people at Bernanke were saying no, no, no. My reading of that literature, with the benefit of hindsight, is that these guys were really lost. They were really lost, I think, to some extent because they confused two issues. One issue is how many targets should you have? And another issue is how do you hit those targets? And if you go back and read some of the reflections by Bernanke and a bunch of other people, what they said was, well, the interest rate is kind of a blunt tool, and if it's a blunt tool for dealing with one problem, don't ask me to use it on 20 problems, which I think is right. It doesn't follow that you shouldn't worry about 20 problems. It follows that you should get yourself a different set of tools. And I think the interesting debate going forward is going to be, what are the other set of tools? For instance, if you believe that the credit mechanism has broken down, and Guillermo has been a big proponent of this, well, do you want to do direct credit? But if you want to do direct credit, who's going to do it? The Treasury or Central Bank? Are you going to do it through the financial system, or are you going to do it directly? And there are a bunch of financial questions involved. There are a bunch of political questions involved. And about that, we haven't really thought about very much. Fiscal policy. I'm not sure that in these circumstances, as the question seemed to imply, fiscal policy is a perfect substitute for financial and monetary policy. Far from it. If the interest rate is a blunt tool, fiscal policy is also a blunt tool. Not only is it a blunt tool, in an open economy, one of the things that we teach students, and I think this one is mostly right, in an open economy, fiscal policy has leakages, right? So you may be using a very strong fiscal policy to get a medium-sized effect. It is much better to have a fiscal policy response, and I do think it is important to have a fiscal policy response, but to couple it with the kind of semi-orthodox or fully unorthodox financial responses we've been talking about. Now, what you do need, however, for any of the above is a government with some cash in hand. Because if you're going to be giving credit to small businesses, you're going to need, get that money somewhere. And believe me, in the middle of a crisis, people don't want pesos, they want dollars. So somebody needs the dollars, or yen, or euros, right? And that means that somebody must be in a position to supply those dollars or those euros. And in that crisis, there are only two candidates: the central bank or the Treasury. And really, central bank technically belongs to the Treasury. So you have one candidate, the Treasury. So you want the Treasury that is sitting on some cash. And this means, obviously, that you must have followed a fairly tight policy beforehand. I mean, this was our big fight in Chile. Back in 2006, I was saying, look, guys, let us not spend all copper revenue. Not because I want to save some money and put it aside in a window and look at it for eternity. No, simply because we want to be sitting on some cash if things turn bad. And lo and behold, the next year things did turn bad and very bad.
Let me just add that I think we should be careful with financial liberalization. I think that though going back to the days before capital markets were liberalized, that the economies were pretty constrained. So the trick, I think, is to have the capital move around and really go to where it's needed, reflect scarcities, and so on. But at the same time, not to go overboard, as we've seen during especially the last financial crisis. So I think the art is really how to do it. At a sort of finer level, but very practical one, the Europeans are struggling with the financial transactions tax idea, right? The Tobin tax. To what extent could we tax? And the sense is that, yeah, if all of them do it, then maybe that's big enough, a group of countries that they can get away. But if some of them, if the UK does not, then it's going to create a problem. So you can see that reversing it even partially and in small instances can be quite difficult. I think what's also instructive is in terms of to what extent there should be more than one target, more than inflation. The difference between the European Central Bank and the Fed, because the Fed has both inflation and, in fact, the economic activity as something to worry about, whereas the European Central Bank has only inflation. And I'm not sure that accounts for all the difference in their respective behaviors, but the ECB was much slower in responding and lowering interest rates, etc. And there were arguments on paper and in pronouncements that they were worried about inflation when it was in fact the time when the recession was hitting the hardest. So that was a problem. I think the fiscal stance or fiscal policy is important, could have been used. I think that when Obama did his first trip to Europe, he was in fact looking, apart from popularity for himself and the US, he was looking for coordination on the fiscal area and received no positive response. So at that point, now as it turned out, both continents did have some natural coordinations because they had counter-cyclical policies built into through unemployment benefits and so on. But it was not because they agreed to do it. It just coincidentally happened as they were both hit at the same time.
Let me say a few words about the issue of inflation. Inflation targeting. One has to define what do you mean by inflation targeting? Because inflation will always be, say, at 2% plus minus some numbers, or is something more flexible than that. And I'm all for flexibility. Based on recent research, where we have been looking at the impact of this crisis on unemployment. And it turns out that the countries that were able to have a high level of inflation during the episode, the real wage fell, but unemployment disappeared very quickly. And there are many examples among emerging markets, no example in advanced economies. So, but this is a spike in the rate of inflation. So my advice about that is not to abandon inflation targeting as a long-term project, but in the short run, when you're in the midst of a financial crisis, where credit markets don't work, sometimes because of mistakes at the macro level, not individual level, some critical sectors become over-indebted. For example, in this country, the private sector, a good dosage of inflation, a hike in the price level, which of course is unthinkable in the United States, but you see several episodes in emerging markets which were accompanied or followed big devaluations, has an effect on unemployment, a very big effect on unemployment. You may or may not like that because the real wage also falls, but there is a mechanism there. The wage, the inflation can help at a certain level, and it's something that should not be ruled out just by definition. But that doesn't mean abandoning the long-term target. The issue of financial liberalization is an issue that I've been working on for years and years, and you never learn and you're never sure. But the more you look at it, the less excited you get about, across the board liberalization. These ideas of the 1990s, I think, are gone because of the many examples where that didn't work. Now, what worries me a lot is learning how liberalization takes place, how those flows takes place. And when you talk to bankers, and you realize that the bankers, we were talking about that, the case of Brazil, they don't know much about what the projects are. I mean, we have this idealistic view of the financial market that helps to efficient allocation of capital. That's what every economist comes out from Econ 101, right? That's what the financial sector is for. Well, I'm afraid that doesn't work that way, because the bankers, when the bankers invested in Spain, they look at the collateral. So that's why real estate is attractive, because you have a collateral there. So they look at the collateral, and I'm talking to some bankers that tell me, I never knew what the guy was going to do with the money, but I knew that if it didn't work, I had something that I could grab. Well, once you say that, you realize that then you don't have perfect markets, that certain activities that have natural collateral will be privileged over the other. So there is a distortion down there, and we haven't done the analysis carefully enough. And as a consequence, that's why when for some reason there's a big devaluation in a given country and the real exchange rate depreciates, the collateral collapses and credit disappears. So that's the best explanation I can have of why then you have a sudden stop of credit, which is what really hurts. So liberalization, I think we don't know how to handle those things. I agree with them that there are many things we can do. It's very hard. On the other hand, you don't want to kill the instrument. Intermediation is important. So I don't know how to position myself there. The other issue is everything you look at as potential remedies for when you get hit or before you get hit in order to prevent this from happening, you can see the negative side. For example, reserves, an issue that came up here. It seems to have been a good idea. Even empirically, we have found out that, say, if you do some probabilistic analysis, that probability of a sudden stop goes down when the more reserves you have. But what is going to happen if the private sector anticipates that the government is going to be there to bail them out? We know at the bank level. So it's good for the private sector to find out that all of a sudden there's a lot of money in the Chile. But if Chile, say, continues doing this, probably the private sector will start taking advantage of the fact that if there is a problem, I can always go to the fisc and get some help. So there is a moral hazard issue here. Okay, so now we can take the second round of questions.
I wanted to talk about the issue of the lender of last resort. Being an Indian, I've actually seen the Indian rupee plummet by more than 10% in 2 months. And we actually have a central bank that would rather let the rupee depreciate, in my opinion, overshoot its fair value than come in and intervene. The problem as of today is while the IMF is there, there's a stigma attached to going to the IMF. What I suspect is if there is a lender of last resort or a global central bank, that stigma will sustain. What solution does the panel have, with regard to having this global central bank or this global wall of crisis?
Please.
Hi, Professor Velasco said something about nirvana, no, like low interest rates and high commodity prices, and now it's practically gone or steady, in commodity prices. And one of the challenges for Latin America was increased productivity, because productivity of factors were pinned down or stagnant. So given this high dependence of the Latin American region in commodities and high commodity prices, is there, a light at the end of the tunnel for diversifying or integrating into the value-added chains of the world in order to, avoid these sudden stops? Or
Hello. I have two questions. One pertaining to central banking and the future, particularly given that Chairman Bernanke has said that he doesn't look at anything else but the mandate in his mandate for the U.S. economy. What does that mean in terms of coordination for the future? If at times if we conceive a world where there's perfect coordination among central banks, there can be conflicting interests there, and some nations may want to do something, and some nations something else. So, in terms of the concept, the mere concept of central banking, I think that's an unanswered question, at least for me. And the second, it has to do a lot with what my predecessor had just said. Given that we cannot put a finger on total factor productivity, if we have followed the textbook reform and done pretty much imperfectly, of course, but to a certain extent, gone through the reform processes, and that hasn't made us achieve that total factor productivity, what's in store for emerging economies, and how do they go about that? What's your view?
Hi, this is a question I think is a little different than what other people have been asking, but I was curious, in the opinion of the panel, what emerging economies have been able to use this period of low interest rates to more widely benefit the poor in those countries, and which countries in the emerging world, like India, like Malaysia, like the ones that were mentioned, are in a better position to withstand the shock that we've been talking about, mostly in terms of protecting the majority of the people in those countries, especially the poor. Thanks.
Hi, just a quick remark. The panel was playing the idea of a super central bank with more objectives and more tools and potentially world central bank. And I find this idea a bit hard to digest, because what I find is lacking in the discussion so far is the question of political accountability of such a super institution. Also, this might seem a very European approach to this whenever there is a multitude of targets. The inflation target seems to fall a bit behind once, because the transmission mechanism is probably the longest between the tool and the effect, and also the uncertainty on the effect of a tool at a given point in time. Thank you.
Okay. Andrés?
No? Thanks. Let me group all of those questions into two blocks, because I think there were some similarities. There were some questions about lenders of last resort, central banks, whether local or global, what to do about them. And there were some issues about growth and equity, which go beyond, and TFP, which go beyond the financial part. Look, I think that the current state of affairs may be nirvana from the point of view of commodity prices or interest rates, but it's negative nirvana as far as our institutional arrangements. Because over the last 25 years, via financial liberalization and other changes, we have created an even greater need than we had before for lenders of last resort, And as Guillermo often points out, the fact that we've had very low interest rates for a very long time now has created lots of liquidity, which is out there waiting for a good excuse to leave Indonesia or India or the Czech Republic or Chile or Brazil, which again makes it even more important that you have somebody out there that play the role of a lender of last resort. Local authorities can and do, but as I said in my remarks in the beginning, they do so at considerable expense, because to be a lender of last resort in dollars, you have to be sitting on a lot of dollars, right? And those dollars that you happen to be sitting on are dollars that you're not using for research, development, housing, infrastructure, health, and all the other things that you wish to be using them for. So this comes as a cost. So local authorities, almost by definition, are ill-placed to do this. So you do need a global authority. You worry about accountability. I worry about accountability too. But let me tell you that the current state of affairs is the worst of all, because the only people we get accountability from, or we could hope to get accountability from, are the guys who are speculating downtown, and we're getting zero accountability from them. So as Guillermo was saying, you go to dinner and after your second drink, so what do you think is going to happen in Brazil? Brazil's looking down. Okay, let's go sell Brazil. It's hard to imagine a less accountable situation than that, right? So, depends on the quality of the drinks, the availability of the drinks, whether you're in New York or in London, what time pubs close, not exactly optimal institutional arrangements. So I think, we have to be thinking about this. Now, I am not blind to the fact that between the time we think about it and the time we get somewhere, decades will go by. I mean, I'm old enough now to know that over the last 25 years, the IMF has tried the CCL and the CCP and the PPM and whatever. I'm making these up, but it's actually CCL is right? They had a CCL, and they've all failed. They've all failed, as somebody said, because nobody wants to be the first mover. Who wants to be the first person to sign up for, the, potential sick list? Nobody wants to. So maybe the time has come to give up on the hope that the IMF will do this, and maybe we should, I don't know, make Janet Yellen the central banker of the world. Of course, Obama has to make her central banker of the United States first, but that seems like a done deal. I don't know. How we get from here to there, I have no idea, but the need is, I think, particularly acute. Then there are a bunch of questions on TFP reforms, etc. This is a very hard issue, and I've done some research and a lot of thinking about this. And let me say in 3 sentences or less what I've learned. First thing that I've learned is that a lot of the structural reforms of the 80s and 90s were oversold as sources of, great productivity changes. Not because in themselves these reforms were bad, some were very necessary and some were inevitable, but because at most what they gave you is a one-time boost in productivity as opposed to an ongoing boost in productivity. You have a badly managed state enterprise, you privatize it, supposing that the private manager is better, which may or may not be the case, you restructure operations, whatever, you get a one-time boost, in the jargon of the profession, you get a level effect, not a rate effect, and then that's it, right? So in a lot of countries that had these reforms, you did have, a short period in which productivity did jump up. In Chile, we had a short period of extremely high productivity growth between the mid-'80s and the early '90s. And then it's been pretty much flat ever since. Which leads me to the question of what the hell do you do? And my view, and here I will confess that I'm quite influenced by endless conversations with 2 Harvard colleagues, Ricardo Hausman and Danny Roderick. I have grown closer to the view that there are 2 ways to become more productive. You can get better at doing whatever it is that you do. That's, the traditional way that we think about, I make copper and I'm going to be the best, lowest cost producer of copper. But eventually, there's only, so much you can improve, right? The other way in which you can get more productive, and this is what Asian economies have done, and increasingly countries like Slovakia are doing, is you can actually do other things. I stop making copper and I begin to make widgets. And, ideally, there are big productivity gains there. So the question in my mind is what kinds of policies, what kinds of coordination with the private sector do you need to move from an economy which makes only copper or only oil or only wheat to an economy which makes a bunch of things. And that is, I am aware, a minefield, right? Because as soon as you say this, people in the back of the audience begin to think, industrial policy, socialism, the decline of the West, all kinds of things. I believe that one can think of fairly obvious market failures are out there, and policies to correct these market failures, and they don't need, to be Stalinistic in nature or anything of the sort. But that's a very big debate, and I don't want to go too long, but I'm happy to engage any of you on the subject, if time permits.
a few words. When you mentioned the example of the Indian rupee going down by 10%, it reminds me that the world has changed in the sense that there is much more volatility, much greater variance in all sorts of things, including the exchange rate. 10% nowadays is not much. It used to be a huge amount. But now, even big currencies fluctuate vis-a-vis each other 20, 30% within 6 months, etc. And we just have to learn to live in a world where this is happening. And if you want to prevent it, and if you want to have certainty, it's much more costly, and effort, etc., will take much more. So there is a question of how far to go. I think I made a good point that there is stigma associated with going to the IMF traditionally. The other part is also it's usually associated with all sorts of constraints and obligations. So countries definitely try not to do that if they don't have to. And so it's the question of how the alternative to it, a central bank, global central bank would behave, whether in fact it would have conditionality, which is even greater or not, or what it would do. The TFP and integrating countries into the global value chain, I think a lot has been said about it already. My hunch is based on micro research, firm level data that we've done now, decades of in various countries, is that foreign direct investment brings about a lot of top-notch expertise, technology, and innovation. So hooking up, and Slovakia is very good, it's sort of the largest per capita producer of cars, and it's the most modern models, obviously, etc. It's the world standard. So that kind of integration is very helpful. We are finding there are spillovers, positive spillovers, so other firms that are supplying the multinationals, or even those that are competing with them head-on in the same industry, horizontal spillovers are there as well. So I think that is probably the way, and it's often associated, as Andrés said, with switching into something else. You don't do just whatever you did before. In a way, we're going through a period, taking in a broader sense, of enormous revolution, internet and so on, the IT and so on, is, so we're not in a period of stagnation. And in fact, it's interesting when you look at individual firms in the United States, for instance, during the recession, they've been innovating like crazy. Ford Motor Company that I looked at has, been doing all sorts of new things ready for the next upturn to bring in, and so did others. So there's quite a lot of innovation going on. It just isn't necessarily spread widely yet. And that's where I think judicious policy of bringing in foreign investment might actually pay off. The comment about Bernanke considering just the U.S. economy, I think that's a fact. I mean, I think that's how we others, if you're in another country, should assume that, yes, people will consider primarily what concerns them, what they have a mandate for, and you should do the best you can, given that that's what's happening. Were the emerging market economies using the low interest rates to help the poor? I'm not aware specifically of it, but I'm aware of the fact that many of them were refinancing their debt and having major proceeds which could then be used for social projects and other things. So indirectly through the refinancing of the debt, I think there probably one would find something like that. And the political accountability of a central bank, that is a wonderful issue, because I think in many cases the independence of central bank policies, which has been sort of proclaimed as a very important thing, has been taken in a number of countries to the point where the central bank is not supervised or monitored, even in many other respects. So it's kind of the independence has been taken as kind of that's an institution on its own, and we don't really mess up with it the way we do with other agencies of the government. So that's actually quite interesting. Maybe one other thing just to support Guillermo's point about people investing in Brazil and not checking really what's going on in Brazil. You notice it if you have a heterogeneous region where some countries are doing well and others are not. But all of them get hit by the stampede out of the investors because they all kind of look at it and say, oh, Southeastern Europe, let's get out. Yeah.
Okay. We are getting to the end of the session. Let me just say a few words about the central banks I guess here we all agree that the Fed is de facto the world central bank, and we've been heading in that direction, not because of clear planning or political decisions. It's just determined by the market. The markets, after all, are the ones who decide what's good liquidity, what's bad liquidity. And for reasons that we still don't understand very well, but I think it has a lot to do with the fact that, for example, there are many international prices that are set in terms of dollars, like the price of oil, that give the dollar a central position. Now, even though the Fed, in its mandate, has to focus exclusively in the United States, one has to realize that the Fed has been very active as a world central bank during the crisis. And one way in which it became very active was through these currency swaps, enormous currency swaps with ECB, Brazil, and other countries. What is that if not monetary intervention? You're just providing dollars so that, for example, the euro would not devalue too much during the crisis. And that was very, very important to maintain the stability of the euro, something which sometimes people wonder, say, given all of this noise, how come the euro is true, is coming up and down, but it's so stable with respect to the dollar? Well, it could very well be that if there is big instability, the Fed will come in and stabilize it at the level which is not considered or too high or too low. Now, why is that? Well, partly because the financial system in Europe is highly dollarized. Many banks have investments in dollars, and they have mismatched. And if there is a problem with the exchange rate, that could lead European banks to liquidate their dollar assets and have an impact on the value of those assets. That's exactly the fear during the crisis. Those assets, many of those assets, like mortgage-backed securities, were backing up the shadow banks, and a massive additional destruction of that kind of liquidity could have exacerbated the crisis in a bad way. So that's an example where the Fed internalizes the problems or strains that you see that emerge in the rest of the world. The problem is, of course, that may work at one point and not at another point. I'm afraid now, for example, that the Fed was much more willing to be proactive in emerging markets during the Lehman crisis, but not now. If there is recovery in the US and India starts having problems of their own, probably they will look the other way because they are doing fine. And that's the right thing for them to do, given the charter, right? So that's a problem. Now, how to create the World Central Bank, I don't have an answer for that, but history teaches us that institutions that played an important role, like the IMF and the World Bank, were created after 2 world wars. That the euro is partly a result of the fear of going into competitive devaluations in Europe and going into a third world in Europe, disintegration of Europe. So it seems to me that we may get there if there is enough fear in the world that what we have now doesn't work. Now, I agree with Jan, who said we had to get used to volatility in exchange rate, but it's a very bad thing.
Yeah, I agree.
I mean, you are producing something in country A, and just because your currency appreciates, you cannot compete in the rest of the world. And that's not a fundamental. It's something that perhaps is the result of some people buying and selling currencies. Yeah. And actually we intervene, so that all of the issues that came up here come to the surface. And it depends on how volatile the whole thing is. But if it continues being that way, and countries that are in principle successful fall on their backs because of changes that it's not a war, it's not a big stone hitting the country. It just happens that there is a devaluation or appreciation that changes the terms of trade right away. That's not, it's hard to find support. And I believe that volatility, in addition, undermines the credibility of the policymaker. Because you can say, we will do these reforms and that, of this type, and to do all kinds of things according to the book. And then a devaluation throws everything out the window, or an appreciation. With a greater, I hope the world will go towards more stability from that point of view. But the recent events, the tapering that we were gathering here to discuss, really sends a very worrisome signal that we are in the midst of a very unstable situation, and we will have to see how the political infrastructure supports and reacts to these events. Well, with this, I will finish this panel. I want to thank everybody who came here, and especially to our two great panelists. Thank you.